Welcome to Your Mortgage Matters, brought to you by Angel Oak Home Loans, your weekly look into what's new in the mortgage business and how it impacts you. And now your host, Mac Cregger.
Welcome back to Your Mortgage Matters podcast for Angel Oak Home Loans. I'm excited today with a special guest, the Chief Marketing Officer at Angel Oak, Steven Winokur, who is going to share with us his insight on where the market's at. He has a unique perspective. Not only is he the Chief Marketing Officer here at Angel Oak, but he's also very connected to originators. So I think you'll see that his expertise really hits on what's going on in the market. Let me jump in right away, Steven, to our podcast here on Your Mortgage Matters and ask you, I read an article last week. I've seen a couple articles in the last 3 months with a lack of trust and a concern about the viability long-term of non-QM products. That's kind of what we've based our entire business on.
Yes, we have.
So tell me a little bit about how you see some of these articles playing into the long-term trust and viability of what non-QM brings to the mortgage market.
Well, first, thanks for having me here today, Mac. So I was just at Originator Connect down in Las Vegas, and there was a part of that session was a non-QM summit. It was a 3.5 hours specifically to talk about non-QM. At 9 a.m. on a Friday morning, we had over 200 originators in a conference room ready to learn about non-QM. So that to me says that said a lot. When I got up there to start moderating and I look out at the room was packed. Like I said, 9 a.m. in Vegas. If you've been to Vegas, getting somebody up at 9 a.m. to listen to a mortgage talk isn't the easiest thing in the world. So
that's right. And this podcast is not talking about what you did the night before.
No, it was
okay.
Definitely
So moving
not.
on. Yeah.
Yes, moving on. But I think that to me really spoke to the power of non-QM and what kind of people they're thirsty for that knowledge. But I look at it a couple ways. First, I think over the last several months we've seen some struggles with non-QM a little bit. And I think the most important thing to remember is this is not a credit issue, right? So this is not an issue of loans that are not performing. This isn't 2008 all over again, right? These are good quality performing loans. And so I think that is very important to remember before we get into anything else. It's strictly a pricing issue. And we went through that a lot at the non-QM Summit to sure. ease the crowd and let them understand. We had some really great speakers come up and talk about that is strictly a pricing issue, not a credit issue. And so the second piece really is the target market of these borrowers isn't going anywhere, right? So the new business applications in 2020 over 2019 are up. I think it's up 40%.
I saw that.
In 2021 over 20, it's like up another 40%. I think 2022 is probably going to be the same over 21. So more and more people are becoming self-employed. They're becoming part of the gig economy. They're becoming graphic designers. They work for multiple companies. They drive Uber at night. They patch together a full-time job. And so I think, to me, the fact that there's this huge amount of borrowers that are increasing that need non-QM, right? There aren't any other outlets for them because they're writing things off. They need the bank statement program or a 1099 program. And so the fact that there's that many people and that's growing really, I think, speaks to the fact that non-QM is not going anywhere.
So there's a huge need. There's even more of a void now because we've seen, unfortunately, other non-QM players exit the space,
right.
which puts a lot more opportunity and pressure and on Angel Oak to step up and fill that void for qualified and underserved markets like right. those qualified for non-QM. A question, though, I have is, I know we projected growth of like double the volume in non-QM this year. And when you talk
right.
to every expert in January, that was the thought. That hasn't happened.
Right.
So what has happened?
So that, it's funny. I led off, so I moderated the sessions at the non-QM Summit, and I led it off with a quick opening. And I mentioned that. And I said there was a non-QM summit back in January. And so I led that off saying there's all these headwinds that pointing to the fact that non-QM is going to double this year. And the year started out that way. The year started off fantastic. Angel Oak set a record. We did over $600 million in March in non-QM. So, we were pumped up. The year was going in that right direction. And then we all kind of know what happened in the market. Rates took a massive skyrocket. Thank you. And so and that sort of slowed everything down. And so I think that's really kind of where I think it's really important to remember that that non-QM not doubling this year isn't a function of credit or anything else. It's just a pricing issue. So agency rates went from, they go from 3.5 to 4 to 6?
Yeah, it seems like overnight. That roller coaster was a little too steep.
Right. And so, non-QM, you need a couple extra points on top, of agency for that credit risk for the investors take. So, you're talking if agency went to 6, non-QM was from the 7 and 8 point range. And I think that massive shift overnight kind of freaked everybody out. And so I think we're pretty confident no matter where the rates end up, non-QM is going to be fine. I think the struggle right now, which is really that there's a volatility in the market, right? So if we knew that agency rates were at 6, we could price our non-QM correctly and keep it there. But when agencies bump moving up and down daily or weekly, and people aren't really sure where it's going to end up, and we got to adjust our rates, I think that just causes the market to just be like, well, let me just kind of stand on the periphery a little bit, see what's going on before I jump 100% in. And I think once things kind of get stable, we'll run a business and non-QM will be fine at whatever price point it kind of needs to be at. We just need to get to that point where we can kind of understand where it's going to be and from a stability perspective.
Okay, let me ask a question, and this is probably something all of our listeners would ask, because here on your Mortgage Matters podcast with Angel Oak Home Loans, I do believe that all the listeners are either loan officers, real estate professionals, builders, people tied to the industry, and they're probably thinking what I'm thinking. I'm tired of hearing about the problems. I've read all the headlines. I know where we're at. How do we move forward the rest of this year and start into first quarter with the non-QM product? Give us some education. Who are the borrowers that are going to be moving into these products or need these products as the economy finds its footing?
So I think there are two major categories of non-QM borrowers, and that amounts to probably 95% of our business today. A good 2/3 of our business is self-employed borrowers. So like I said, more and more people are following this great resignation. They're leaving their W-2 jobs, either starting their own business, becoming a contractor, and so those people are becoming more and more plentiful, right? So I think there's more and more people that are out there, and I always kind of joke around. I'm like, if you start working with a self-employed borrower, someone who owns their own business, who do they usually hang out and know? Is other self-employed people who own their own business,
Exactly.
right? So if you're a 1099, you're working as a contractor. Like I said, you kind of hobble together a full-time job with some Uber driving, some graphic design, some other things. Other people that do the same thing, right? And so when you start getting into that niche, you start to get known for that in that marketplace. So if you're working with one business owner and you find her a house and she's ecstatic that you're able to get her into a house, well, she's going to tell all of her friends, hey, go talk to Mac. Mac got me in this house. He can get you into a house too. And then the second one is property investors. We were just doing some statistic updates, and I think it's 36% of homes are rentals and
Wow.
and owned by and most of those are owned by people who own 1 to 2 homes. They're
Sure.
not the Black Rocks, right? They're the small mom and pop sort of. They own a property here or there, and those folks are increasing. More and more people are trying to get into property investing. So those markets really are growing too. I think the important thing to really get to that point about the positivity is thinking about these markets are growing, right? So all the the business, I think NBA just said it's down 40% quarter over quarter. Like there's all these, you're right, there's a lot of negativity in the marketplace, but I think thinking through these target markets have no outlets, right? So if you find this business owner alone in a property, get them into
Sure.
a house, first of all, they love you because they didn't think it was possible. Right, and then you're able to get them into a house, so they're ecstatic. You got the loan. The realtor's happy. Everybody in the process is happy, and like I said, then that leads you to more of those folks because you were able to save the day.
Yeah, you're spot on. I think the target markets you just mentioned so valuable for originators, for real estate professionals, for builders to think about. There is a target market for these non-QM. Let me keep you on the hot seat. We're fortunate enough to have Steven Winokur here with us today, and he's the Chief Marketing Officer of Angel Oak Lending. And so to keep you on the hot seat, I do hear from time to time still that it is a subprime loan. So Tell me why this is not a subprime loan.
Yeah, it's funny. Several years ago, we were I thought that we were kind of getting past that people were now understanding this isn't subprime, and I talked to some loan officers, and they're like, no, realtors still use that. They don't want to do it. I think it's bad subprime. So I think our average credit score is over 740. Our average LTV is in the low 70s. These are not bad loans. They're not bad credit risks. We went through the process for the COVID. I think one of the criticisms before COVID hit was, well, these loans look good, but they haven't been tested, right? And so COVID was sadly, it was horrific for the world, but provided a test for non-QM loans. And I think we came out, the statistics show that our loans performed as well as the government and conventional loans did. So I think that showed that these are not subprime loans. The credit scores are there, the LTVs are there. And then the other big thing, I think, is ATR. So this is one thing that I think that ATR is ability to repay. I think a lot of people don't understand that non-QM loans, while they're non-qualified mortgages, they fall outside Dodd-Frank, we still have to follow the ATR regulations. So we still have to qualify them that they have the ability to repay. And so this isn't one of those where you walk up, I'm self-employed, I make $500,000 a year, give me a loan, like the old stated stuff, right? This is, we have to document income. We just document it with bank statements and not tax returns. But our loans are all fully ATR compliant. They're all income is fully documented. Like I said, the credit scores are high, LTVs are low. It's what's not to love about them.
Okay, that all makes sense, and I think that's a great way to explain how it's nothing even close to what we call subprime. But why is it then that we've seen so many of our competitors and top non-QM lenders go out of business just this year? We've had two recently that I would call mainstays in the non-QM space that shut their doors. So if it's all high credit, low DTI, qualified people, what went wrong?
Well, I think, and I don't know enough about the individual cases for the two companies that did go out of business, but I think going back to the fact that it's not a credit issue, it was just a pricing issue. I think one of the problems I think that people, and not just the two that everybody ran into, I think Angel Oak ran into a little bit too, was when rates went up so fast. So we were, it takes a couple months for a loan to close, pay it, get funded, all that, and then get into a securitization. So during that time period, the rates skyrocketed. So we were holding, and our competitors were holding loans with non-QM loans in the 4s. Well, agency rates were in the 5s.
Right.
So if you're an investor, you're like, well, I can buy a securitization of non-QM loans in the 4s, or I can look at agency stuff in the 5s, which is backed by the government.
Sure.
Why am I going to invest with non-QM? So I think what ended up really happening to a lot of people was they were holding loans, the rates went up so fast, and they had no outlet to get rid of the low coupon loans. And they got caught. And this stuff's above my head. The hedging part and all that, it's just harder to hedge non-QM loans than it is conventional. So I think that just caught a lot of people sort of flat-footed, and unfortunately caused the demise of a couple of our friendly competitors.
Thank you, Steven. You're spot on with being so descriptive, yet to the point with these answers, and I know our listeners are grateful for that. Steven Winokur, Chief Marketing Officer, Angel Oak Lending, here on Your Mortgage Matters podcast. I want to ask a question for all our real estate professionals that are listening. You've talked a lot about these emerging markets with small business owners and with investors. Should the real estate community be targeting that audience? And how do they proactively do that? Because we've seen mortgage applications fall off in July by 40%. Right. And it's the low in 22 years. These crazy stats are coming out. So all of us as salespeople are out trying to generate opportunities. Is this something that a real estate professional can proactively really focus on and target?
Without a doubt. I think going out to networking events, we've been using this it's sort of this concept of it's time for loan officers, realtors to get back to basics, right? I think for the last couple of years, I think you could get away with sitting in your office, sort of waiting for, maybe you automate an email blast every so often and kind of wait for business to come in. You can't do that now. Like you just said, business is down. You kind of got to beat the pavement. And so we've been using this concept of it's time to get back to basics, right? Kind of that old school guerrilla marketing, hitting the streets, going to talk to people. And so I think, going to networking events where self-employed people hang out, we were talking about, one of the people at Non-QM Summit mentioned trade unions, right? So those are good spots to meet folks. Talk to CPAs, right? They're the ones that do the taxes for self-employed business owners. Money managers. So the great thing about money managers is they want, if you're a self-employed business owner and you're trying to buy a house and you don't know about a bank statement program, either you don't buy a house or you end up having to pay cash.
Right.
Right? Well, if you're a money manager and someone's got $1 million invested with you, you don't want them pulling out $1 million out of their retirement accounts to go buy a house. You want them pulling $200,000 out and doing an 80% down, not bank statement loan. So talk to the accountants. Let them know these programs exist. To us, that's really, I think, the biggest sort of stumbling block of maybe what's prevented non-QM really from taking off over the last couple of years. It's been growing very considerably, but I think it's education, right? Like I think a lot of loan officers still don't know these programs exist. Realtors don't. The referral partners definitely don't. Accountants don't. Money managers don't. Attorneys don't. And so going out there and educating them and letting these people know that, hey, I can help your self-employed borrower.
This is why this podcast is so important and valuable is just in the last 15 minutes you have shared with us information about how someone can grow in the real estate space and the mortgage space through these non-QM loans to qualified and underserved borrowers. So I appreciate you sharing this because I think this is the education the market needs because it does exist and we got to make sure we're explaining it. A question though, I'm sure that borrowers and our real estate professionals and builders are trying to wrap their mind around, if I come to get qualified for a non-QM loan, I'm looking at a point, even 2 points higher than just a normal agency loan. Right. That's a big change. Tell me a little bit about why that's still beneficial for a borrower at a higher rate.
Well, so first off, I think it's important to understand that non-QM is backed by private equity, private money. So agency loans are all backed by the federal government. They have the backing of that. They're all fully guaranteed. Non-QM loans are backed by private money. So the investors need a little bit extra to cover their risk. And so that's where that 1 to 2 points comes in. But I think non-QM is still, and I've heard these from people who are like, well, either why don't you wait 2 years and build up some more down payments so you can get a better rate, or wait and get your credit score better, or like the worst advice is go ahead for a self-employed borrower is go ahead and file taxes without write-offs for 2 years so your tax returns look better, and then you come back and get a loan, right? Those are all terrible financial decisions. It's still beneficial because one of the things that self-employed borrowers, the troubles they have is their tax returns show a lot of write-offs, right? So that's what a great accountant will do for you, right? Great Sure. CPA will make your income disappear. All legal, like this. We're not talking about fraud. It's all using
lightening the tax burden.
Right. All following the IRS. We joke around. There's like a 500-page tax code. So, but they understand that you have two options. You can either pay, like we talked about, 35% in your taxes, and then pay an agency rate, or you could pay 1.5 points higher and save all your money on your taxes. So that to me makes the ton of sense. And I think what we've seen is that a lot of self-employed borrowers are savvy. And so they might balk it for them. They might be like, what? I just read the newspaper said the rates had just dropped to 5. Why are you quoting me 7? Right? And you explain the situation to them, and then you explain the benefit they're getting from buying the house versus the tax write-offs. And they quickly understand the benefit they're going to get from buying the house.
Well, that makes sense to me. And as many refinances as we do in the non-QM world, it goes back to the phrase, marry the house, date the interest rate. At the end of the day,
right.
You do have the opportunity to refinance on these loans.
Mm-hmm. Yeah, we talk about that with loan officers, that a lot of times it's a 2-for-1 loan. Right, you get them in the house, especially I think when we have some of the programs for people who've had credit problems. when you get them into the home at a higher interest rate, and then when their credit cures or foreclosure comes off one of these problems, and the rate they can qualify for an agency loan. You refi them 2, 3, 4, 5 years later, agency loan. You got both loans because you were able to get them into the house with a non-QM loan right away, instead of telling them to wait 4 years until their foreclosure comes off their credit report. Get them into a house today at a higher interest rate. Let them start earning equity, and then like you just said, refi them when they're able to.
Yeah. Thank you. One last question for Steven is, we're vertically integrated. I hear that all the time around here. When I walk around the office, we're the only vertically integrated mortgage company in the industry. Why is that so valuable? Can you explain to me? We're always promoting our relationship with our asset management company. How does that affect us as a lender, and how does that help grow Angel Oak Home Loans?
So I think, this is related a little bit about what we talked about before with some of the companies in the space. I think the one thing it really highlights is our commitment to the non-QM space, right? So some other companies had investors, but that wasn't their main focus. And at Angel Oak, our main focus, all the way from origination through securitization, is non-QM, right? So we're fully committed to this space. But I think the advantage of having a capital markets partner like Angel Oak Capital is it allows us to write our own guidelines, to loan to our own guidelines. So we don't need to send our loans to an investor to be like, hey, are you okay with this, before we do an exception, right? I think 25% of our loans have exceptions. We're able to do that without having to call a final investor. And to me, what the benefit that has to an originator and realtor is this element of trust, right? If a loan officer tells the realtor, based on what you've sent to me, we're going to do this loan at 80%, we're going to do the loan at 80%, right? Because we know that our capital markets partner will buy it at 80%. It isn't a situation where we're going to say, we'll do it at 80, and I've heard this happen to many people, is we'll do it at 80, then they send the loan off for final investor review, and they're like, yeah, we really need another 5% down, right? And that's like, after it's been in process for 2 months. So now the borrower's got to come up with another 5 or 10%, sure, like that week.
It's difficult, yes.
Right. So, I mean, I don't know about you, but, by coming up with 5 or 10% for a purchase of a house in a couple of days isn't the easiest thing. So I think that's really where it speaks to the benefits for an originator or realtor, is just this element of trust.
Well, I'm pumped and ready to go, and I'm sure everybody who's listening to this is. Today on Your Mortgage Matters podcast with Angel Oak Home Loans, we've had a special guest in Steven Winokur, our Chief Marketing Officer, and he has laid out for us and answered every question that I could ask him on how to grow a business with non-QM in these unique times. I think there's many super beneficial things we've learned. Steven, I appreciate your time. I know it's valuable.
Glad to be here.
For all those listeners, angeloakhomeloans.com, angeloakhomeloans.com. You can easily scroll through the site, find the state that you're in, apply with a loan officer that is local to you. We are a local mortgage company nationwide in many different markets, and we look forward to the opportunity of helping you grow your business and serving your clients and serving you. I appreciate your time today, Steven, and we look forward to speaking to you again soon.
Excellent. Looking forward to it.
Thank you for listening to Your Mortgage Matters podcast, brought to you by Angel Oak Home Loans, where achieving your unique personal or business goals for financial success matters to us. It's all about you. Help us educate others. Please pick up your mobile device and hit the like and share button now. Angel Oak Home Loans, LLC, NMLS 685842, Equal Housing Lender.